Thank you for joining us at XM.com. You're watching today's market comment by Haralambos Bisuros. I'm Cristina Marujas. The yen was the sole currency to end Tuesday with gains against the US dollar, unexpectedly and instantly surging after dollar-yen breached the 150 level. That barrier was closely monitored by traders and considered as the line in the sand, which, if breached, could force Japanese authorities to intervene. Thus, yesterday's move stoked speculation that this was the case, although Japan's top currency diplomat, Masato Kanda, said today he would not comment on whether they have intervened in the FX market. Now, the big question is whether dollar-yen could hold below 150, as there are still several key U.S. data that could add more fuel to the dollar's engines. Following the better-than-expected ISM manufacturing PMI on Monday and the unexpected increase in JOLTS job openings yesterday, the focus today is likely to turn to the ISM non-manufacturing index, though the highlight of the week is likely to be Friday's non-farm payrolls. More data corroborating the Fed's higher-for-longer mentality is likely to push Treasury yields and the US dollar higher, which, combined with the Bank of Japan's decision to maintain a lid on Japanese government bond yields, may drive dollar-yen higher. With the pair now resting only 80 pips below the 150 level, it will be interesting to see whether another breach will trigger a second round of intervention by Japanese authorities. Even if it doesn't this week, another breach above the 150 zone may be inevitable as long as the Bank of Japan stays dovish and Fed officials remain hawkish. The risk-linked Aussie and Kiwi were the main losers, as apart from a strong dollar and concerns surrounding China, they were sold following the decisions of their own central banks. Early on Tuesday, the RBA held rates unchanged, and although it kept the door open to more hikes, it struck a cautious tone, while overnight, the RBNZ stayed sidelined and offered no hints on whether they are considering additional rate increases, following the much better-than-expected GDP data for Q2. All three of Wall Street's main indices slid more than 1% yesterday, with the Nasdaq losing the most and the Dow Jones turning negative for the year for the first time since June. With investors not yet fully convinced that the Fed would proceed with another hike this year and that fewer cuts may be on the table for 2024, there is room for further upside adjustment should data continue to support the Fed's view. This means that there may be more declines in store for equities. This was today's market comment. Thank you for watching at XM.com.